And before we took that break, we were talking about true diversification, what that means, and how we can protect your portfolio through diversification in a market downturn and reduce the risk, especially in retirement. And if you're not in retirement, how to grow your investment. So what is true diversification and how does it help you, you may ask? Well, first you could say that there are 4 investment objectives or pillars that every investor wants out of their money in their portfolio. Of course, the first being growth, to put it simply. And then the next one is safety. Furthermore, we all want our money to be safe, or to put it mildly, no one in their right mind wants to lose money. And then the next one is liquidity. We need to have some remote access to it in case of emergencies and regular spending issues. And then lastly is income. And most of us saved money or are saving money for a simple reason. Later on in retirement, we will probably need to spend some of this money for supplemental retirement income to add to pension or Social Security payments. It is nearly impossible to get all 4 of these objectives out of a single investment product or stock or mutual fund or insurance product. Each investment or product that is available today that I know may do one or more of the objectives really well, such as growth, potential, and liquidity. We can use stocks and mutual funds for that, but that's not the safety part. And for safety and income, fixed annuities, but they're not liquid. So in order to achieve all the objectives, rather than having diversification amongst asset classes like large cap, mid cap stocks, we should have true diversification between investment products that satisfy the 4 objectives that we all seek out of our money. So a good way to divvy this up would be to separate your assets into 2 different categories and then choose individual investments and diversified investments, not asset classes. That will satisfy the objective you set for each side of the portfolio. Use safety and income as one side of the equation and use growth and liquidity as the other side. So in this example, you could position things like treasuries, CDs, fixed or pension-based annuities on the safety and income side and choose the best investments that satisfy those investment needs. And then on the other side, you could choose a mixture of diversified mix of stocks, bonds, mutual funds, and ETFs to create a growth and liquidity-based portfolio. And we definitely want to stay away from variable annuities, hedge funds, and REITs on that side. So taking a step further, you would want to invest the money on this side with risk-based objectives like a conservative piece with dividends and yield, a moderately aggressive piece for more growth and capital appreciation potential, and an alternative maybe so we can add some non-correlated to the direct equity markets. The moral of the true diversification pitch, if you will, is that you want to protect the amount of money you need to produce your baseline income from monthly income standpoint using principal, protected, or secure investments. In other words, don't risk the money you can't afford to lose. Then for some or all of the discretionary income, you could use risk-based diversified investments on the remaining money you didn't protect.